Welcome to Inside the Deal. I'm Trent Zeigler, your host, and this is where we break down how real operators are actually building, scaling, and closing deals in real estate today. Today, I'm joined by Randy McMullin, owner and president at Amstar Mortgage Network. Thanks for joining.
Hey, Trent, thanks for the invitation. Glad to join.
Yeah, absolutely. So let's go ahead and dive right in. For the viewers, what does someone in real estate financing do at a high level?
What does someone in real estate financing do at a high level? So basically, anytime someone wants to buy a home, they obviously need financing. It's kind of turned a little bit. I think when I started in the industry, people used to go find a home and then they would come back and get financing. And today it's flipped around, whereas you get your financing first, and once they know that you're approved, then the realtor wants to go out and show you homes that are within your budget. So I'd say that's probably kind of how that changed. But for the most part, our job is to educate clients and let them know that there's a lot of different types of products that are available out there. And there's a lot of confusion about which one is the best fit. And
Mhm.
so our job is to kind of explain all the different variables that are out there, let you know what the best options are, and then explain obviously certain other things about title appraisals, how does credit impact your interest rate, and that type of thing. So I'd say our role is primarily educational.
Right. Okay. Well, give me the quick backstory. How did you get where you are today, and how long have you been where you're at today?
Okay. So gosh, I studied mechanical engineering in college, so I have pretty good at the numbers aspect of it. And I started off working for a couple of corporations outside the mortgage world. I worked for a little company called Circuit City Stores for a while back in the 80s. Stayed in the audio video world. I actually got to work for Philips, launching flat panel televisions in the United States, which was kind of fun. So I had a real kind of a corporate background. And then in 2003, I switched and moved out of that world and got into the mortgage world. Started my own mortgage company in 2003. And so I've been, I guess, doing loans now for about 23 years with my own company. It's
Nice.
been a pretty good ride.
Yeah, oh, that's awesome. So what was the what inspired the transition from one world to another, video, audio to real estate?
Wow. Yeah, that's a really a tough one. I guess there was a part of it where I looked at what I was doing in different companies. And at one point, I kind of went to one of the owners and just said, "Hey, I'd like to make more money and I need a raise." And he said, "Well, no, that doesn't work like that."
Yeah.
And so I started looking at other options. And I said, I've been making people money for the last 20 years. And what I'd like to do is just find a way where I could make myself some of that money. So I ended
Mhm.
up looking at what was out there, seeing what was available. And I kind of looked at it and said, I didn't have a big background in the mortgage world, but I was really good at analysis and math. And so I just took those skills and started introducing myself to real estate agents. And then 23 years later, here I am.
Here you are living the American dream for 23 years.
Yeah.
I love it. Well, zooming out, talking about the industry a little bit, what major shifts are you seeing in the industry right now at large?
I would say there are some shifts, but I'd say there's also some really significant misunderstandings in the industry. It's amazing how many people I talk to today that still think you have to put 20% down to buy a home.
Mhm.
And that they're like, well, we're still saving. I'm like, well, no, there's a lot of programs where, there's FHA with 3.5%. The conventional loans really only require, if you're a first-time home buyer, only 3% down. So you can get in with a pretty minuscule amount of money.
Mhm.
And then the question is, well, which option is, and this is where we kind of help people, which option is going to work better? Would I be better off doing a conventional loan, or is FHA going to be a better option for me? And what are the pros and cons of each one of those different types of options? So that's a little bit about kind of maybe the perception. I'd say the biggest challenge today is, since 2019, home prices have had an unprecedented increase in value. And we've seen home prices go from, 400,000 to 600,000, 400,000 to 700,000. So that increase has created a real challenge for a lot of people. And
Mhm.
then the other part of it, and it kind of comes into play with both of them, is that we had 3% interest rates for so long. A lot of people, if you didn't know, if you hadn't been in the mortgage world for a long time, you would expect that, gosh, 3% is kind of the norm.
Yeah.
So for people growing up that would say from 15 to the time they were 25, that period of time, their rates were around 3 or 4% for a lot of that.
Mhm.
So today, rates are in the low sixes. And so for a lot of people, that's been a really big shift.
Hmm.
So those two things combined, I guess a really easy way to put it is just affordability has
Right.
become the big factor. And what people could afford and with a 60 or $70,000 income in 2019, it's a completely different picture than it is
Hmm.
in 2026. Now, to be fair, if you look back and go back historically, rates in the sixes, the low sixes particularly, those are better than average historically. If you back out, that period where rates were really low.
Yeah.
So I think we're at probably a pretty good interest rate. They're not bad rates. It's just that the cultural shift or the mindset shift to go from a $400,000 house to a $600,000 house kind of caught a lot of people off guard. So when they look at that and look at the payments, I would say that's probably the single biggest market issue right now.
Yeah. What do you think is driving those factors?
Well, interest rates are driven by mortgage-backed bonds, and that's where mortgage rates come from. A lot of people get confused and they think that the Fed chair sets mortgage rates, and the Fed chair sets what we consider to be short-term rates. The Fed funds rate, basically the overnight rates, the rates that you would borrow if you're doing short-term lending, those are not mortgage rates. So, interestingly enough, last October, when Fed Chair Powell lowered the Fed funds rate by 0.25%. That same day, mortgage rates had one of their largest increases of the year, and they went up 0.1% that day. So there's a little bit of a misconception about where rates come from. But I would say right now, particularly right now, the market's just very, very volatile. It's not sure which direction it wants to go. I think most of the forecasts are saying that the rates for the year will be between 6 to 6.5. And I think that's fairly close. I think we might be able to see some rates in the upper fives at some point towards the end of the year, but
Mhm.
there's just not going to be a huge shift.
Right.
So, rates went up because, you know, it's kind of a funny thing. If you think about why rates got to 3%, and a lot of people say, man, we're ready for rates to get back to three. In the mortgage world, we kind of hope we never see 3% rates
Yeah.
again. If we see a 3% rate or 3.5 or four, that means something is really, really, really bad with the
Hmm.
economy.
Yeah.
And so that's what happened the last time. The economy got bad. They lowered the Fed funds rate. Mortgage rates kind of trailed and came down below that. And it was a choice. And the Fed's made a really interesting choice. If you remember at one point when the economy got real soft, they started doing, we're going to send everybody out $500 to stimulate the economy.
Right.
Well, as we all know, $500 will get you about two trips to the grocery store, and then you're back to where you started.
Yeah.
So the feds did something really creative and I think kind of smart. Instead of sending money out, they said, you know what? We're just going to take all this money and we're going to buy mortgage backed bonds. And by buying these bonds, they drove those rates down to three. When they took their foot off the pedal, rates obviously floated back up.
Right.
So I'm not sure we want rates to go back down to the threes, but I think if we stay in the low sixes to upper fives, that's pretty healthy. So I think part of what drove that was the rates was a kind of a bad economy. Now we're shifting into a stronger economy. And then the psychology, honestly, of, you know, higher payments, it's just something people are going to have to deal with.
Right.
If you look at what happened, yeah, home prices went up. But one thing that everybody also is going to relate to, what were you paying in rent in 2018 or 2019?
Hmm.
Because that's not what you're paying today.
Yeah.
So the big factors were, a kind of a blip in the economy where we drove rates down temporarily, and the fact that, when COVID hit, people all of a sudden didn't have to be any particular location. They could go anywhere. So that plus 3% rates drove people just to buy and move, and people bought larger houses, and just a lot of things happened during that period that drove those rates up. And so I don't think we could see some softening of home prices, but I don't think we're ever going to go back to where we were anywhere close to 2019 or 20.
Right. So how did all this impact your business and your growth strategy over the year?
Well, one of the big things that has to do with, affordability, and one of the most common questions that we get, or maybe a comment would be a better way of putting it, is, I think it's cheaper to rent now than it is to buy. And so that obviously is going to impact every mortgage company out there. People are going, well, I can rent instead of buying now.
Right.
So, one of the biggest problems with the math that people did is they will compare their rent. Let's say they're renting for, $2,000 a month. And if
Mhm.
they want to go buy, it's $2,500 a month. They're saying, hey, I save $500 a month just by renting. And so I'm going to save $6,000 a year. In 10
Mhm.
years, I'll save $60,000. I'm going to be further ahead.
Yeah.
Well, here's the part of that they kind of forget to factor in. First off, your rent's 2,000 a day. 2 years, 3 years, 4 years from today, it's not going to be 2,000. It's going to be 2,400, 2,500. 10 years from today, you're probably going to be paying a lot more than 2,500.
Mhm.
So that's the first mistake. And then when you look at that, it kind of goes, wait a minute, that starts to even the picture out a little bit more. In fact, it makes it look like the mortgage is actually cheaper. But here's the really big factor that gets left out. I've seen this 100 times. People will compare a 30-year mortgages to 30 years on rent.
Mhm.
I'm 20 years old, 25 years old, and I can rent for, going to take me till 55. I'm like, well, the question is, are you planning on dying at 55?
Yeah.
No. Oh, so you'd like to live to 85. So you got 30 more
Yeah.
years that you're going to rent. And by the way, my house is paid for.
Yeah.
I have zero. And so
Yeah.
your rent in 30 years is not going to be 2,000, it's going to be 4,000 or
Mhm.
more. And so when you look at it in that vein, it is a huge, huge difference. I mean, it's quite obviously, that everybody knows home ownership has created more millionaires than anything else in the country. So to back up how this has impacted my business, it's become even more of an educational business where we have to really do the math for people to look at it to see that it makes sense. A lot of people just want a home for the benefits of owning your own home,
Mhm.
painting the colors you want, decorating the way you want, living where you want, doing have a backyard.
Mhm.
So those are the things that people know. We just have to go back and reinforce the financial decisions for a lot of people because that's where it really comes down to is can I afford it and how does this make sense in the long term? So we just educate people. So I would say I do a lot. I've always done a lot of education. I'd say we probably do more of the mathematical part of it to people look at it. And then when they see it over the long term, it's that big aha moment. It's like, oh, wow, I never thought about it quite like that before.
Mhm. Yeah, it's the dangerous line of because some people consider your home an asset versus others do not consider your home an asset, or rather your mortgage an asset because you're what you're paying in, ultimately you'll get it back out.
Yeah. And there's, the government's got it set up now too, where, the tax benefits of home ownership, this is another thing that people don't consider is,
Mhm.
you're going to move from one house to another house. But if you buy a house for 400,000, you live in it for 6 or 7 or 8 years, and now it's worth from 400,000, it's gone to 600,000.
Mhm.
Right now, when you sell that house, if you're single, the first $250,000 is tax free.
Mhm.
That's a pretty big benefit. If you're a
Yeah.
married couple, $500,000 of that money is tax free. You're going to find a really hard time where you can put 5% down, which means you can leverage your money 20 to 1.
Mhm.
And then when that money goes up in value, you get to take that leveraged appreciation
Mhm.
tax free.
Right.
That is just a massive, massive benefit.
Yeah. Almost seems like a no-brainer there.
If you're in the industry and you do the math, it kind of is. But if you've never seen the math,
Yeah.
and honestly, when I grew up, my parents didn't explain all the math of this to me.
Mhm.
So there are a lot of people just have never seen it, and it's just something that you need to kind of look at. And once you do, it does kind of change your mind a little bit.
Yeah, absolutely. Talking about Amstar Mortgage Network,
Mhm.
what's working well for you right now?
We've got a little different business model. There are a lot of models out there. Some people like to buy internet leads and that type of thing. I've spent a lot of years building relationships with my real estate agents, with my clients, and it's kind of an interesting thing for me. I had read a statistic in 2016 that something like 83% of people that use a realtor to buy their first home do not use the same realtor to buy their second home. And that was a kind of a shocking statistic to me that many people don't go back. And so I started looking at my own business. I said, well, I'm not probably getting 100% of people come back. So where are they going? What's happening?
Yeah.
And I just started following up with my client base on a regular basis. And every couple of weeks, I'll just say, here's what's going on in the market. Here's some information that you might need, just kind of a touching base thing. And so now for my business, we are 100% referral based.
Mhm.
Realtor agents, past clients refer business to us.
Mhm.
I got a client who called me back from 2006
Wow.
that I closed on a loan last week. And it was really interesting because he said, "Do you remember our last closing?" I'm like, I wish I could remember that, but I don't. He goes, "Well, when we went, our son was 1, and now our son's in college. And,
Yeah.
because of some of the stuff we did with our housing and investments, it's really paid off well." And you really love to hear stories like that. But people
Mhm.
coming back after 10, 15, 20 years.
Yeah.
And of course, when you close a client, I just had a client this morning that said, "Hey, you closed my loan 3 years ago. My sister's getting ready to buy a house. Man, can you help my sister?" And so those are the things that you really enjoy hearing. And so I would say for us, it's just staying in touch with people,
Mhm.
educating people. Now I do some, my basic post and some things of that nature. And I get a little bit of business maybe from some other sources, but it's not something that we really look at.
Yeah.
Um, I really, I'm probably different than almost every mortgage person out there in the regard that I'm really not going after every single loan I can possibly get. But
Mhm.
what I want to do is I want to work with clients who are serious about making a purchase, educate them, and then say, look, this is a big purchase. It's not just about this purchase. I know you're 35 years old or 40 years old or whatever the age is, but let's talk about what you plan on doing 5 years, 10 years, 20 years down the road, because there
Mhm.
may be some things that we can do now that would help you down the road if we structure this loan
Mhm.
correctly. I'll give you another example. I've had clients that will come to me and they're saying, Randy, we're going to be in this house for maybe 2 to 3 years. And it's a short-term purchase. It's because we just got married. We're planning on having kids, but this is our starter house. We want to stay here, build equity for 2 or 3 years, and then use that equity to buy our next house.
Right.
And so we talk about what's the best way or best strategy to do that. And one of the things that just absolutely blows people away, there is a term in the industry called APR, and it stands for annual percentage rate.
Mhm.
And for many years, people would use that as a gauge as to how to measure what's the best loan. The lowest APR is the lowest rate loan. Well, that's true if and only if you plan on staying in the house for 30 years and never making a prepayment and you never make a late payment. So if you stay there 30 years, that's the best way.
Mhm.
Most people don't stay in it. In fact, I don't know if I've ever had a client stay in a house for 30 years.
Mhm.
Uh, most of them have been there for 20 or 25. Um, they've moved several times by now.
Yeah.
So what happens is I have to explain that there's a different way of looking at your mortgage that might be different than you've considered before. Excuse me. One of the things that we have to explain to people about when they're getting a mortgage is not the APR, but I kind of introduce them to another idea, which is what is going to be the lowest cost loan for the time frame that you plan on keeping the home. It's a
Mhm.
very different question than what's the best rate over 30 years. I'm only going to be there 3 years. So one of the things that really catches a lot of people off guard, and let's just say, I'm going to make up an example. Let's just say rates today are 6.25% with no points. Just a basic baseline rate is 6.25. A lot of people know that you can pay money to buy the rate down.
Right.
So maybe I want to buy it down to 6% long term. So I pay 1% up front, which on a $400,000 loan, you're going to pay $4,000 to buy the loan down. I'm going to take you in a different direction. I'm going to say, wait a minute, you're at 6.25. Why don't we take 6.625 and let's go up in the rate by 3/8 of a point. And the initial reaction is, whoa, no, why are we going up in rate?
Mhm.
Well, the reason is this. If you go up in rate, I'm going to give you $6,000 as a credit towards your closing cost. So all of a sudden, you've got $6,000 less at closing. Now your payment went up $100 a month because you took a higher rate. So here's the math: you save 6,000, over the course of 36 months at $100 a month, you spent $3,600. You're going to have $2,400 extra as a savings because you save $6,000 up front instead of paying an extra $100 less during your mortgage. So
Right.
it takes them a while to kind of look at that to go, wow, that kind of makes sense when you put it like that. So again, that's a part of the education that we have to let people know that maybe the things that you heard growing up, maybe there's a different way or a better way of doing it now.
Yeah, absolutely. Insightful. Yeah, I didn't know that. I didn't know that you could opt for a higher interest rate so that you could get a credit back.
Yeah, one of the things that I had some clients that were, buying when rates were at like 7.25, 7.3, because rates had spiked a little bit last year.
Yeah.
And we were talking about, what's the best strategy? And they said, well, we think rates are going to come down. We just don't know when. And I said, yeah, I think rates will come down too, but I think it'll happen the next year or two.
Mhm.
And so here's an interesting thing for them. Instead of buying a house and paying 7.25, what about buying it and paying 7.75? That's a half a point over. Now I'm
Mhm.
going to give you $8,000 towards your closing costs. But oh,
Right.
by the way, rates have fallen out of 6.25. Now you can refinance. So you didn't even have to pay any closing costs on your first closing. You
Right.
saved all that money. And then when rates came down, now you use that money to refinance into a lower rate.
Interesting. I might use that one. I
Yeah.
might just use that one.
it's
Um,
a good strategy depending on the market. We're at the point now, I don't know if it makes quite as much sense,
mhm.
but when we had that spike, anytime you have a spike like that, that's something you ought to consider.
Yeah, absolutely. Well,
Yeah.
on the flip side, what's been frustrating for you? Where have your hangups been?
Probably the same as most people in the industry. We work with, and I can't tell you how many people I have worked with just in the first 4 months of the year. I can't even count the number of people I've like, I want to look this and I want to do this. And so there's a lot of interest. And one of the frustrating parts is I've probably prepared 40, more than 40 worksheet estimates, closing costs, escrows, looking up taxes, looking up title insurance,
Mhm.
preparing a bunch of information. And we're thinking, and there's a lot of people that kind of get that information and then they just disappear. So you end up doing a lot of work. Sometimes it doesn't pan out. That's a little bit of a frustration.
Yeah.
The other things are, that's outside of your control, which is appraisals. We don't have any control over appraisals. In fact, most people don't know we're not even allowed to talk to your appraiser.
Oh, interesting.
Yeah, and it's for the customer's benefit. I'm not going to name the lender, but a national lender got caught many years ago telling that their appraisers that if you don't bring this house back at the value that we need, we're going to fire you and we're going to hire another company. Well, if you've got $500 in appraisal and you're doing 1,000 appraisals,
Uh-huh.
you don't want to lose $500,000 in revenue a year. So you bring that house in at value. Maybe it should have come in at 420 and you brought it in at 435 because that's what the sales price was. You
Mhm.
artificially made it work.
Right.
So when they found out about that, they said, you know what? We're not going to let lenders talk to appraisers anymore. It puts too
Mhm.
much pressure on that relationship. So
Yeah.
they created a thing called the Home Valuation Code of Conduct, which separates lenders from appraisers.
Okay.
So we can order an appraisal and we can talk to them about timing and things like that. We just don't talk to them about value.
Right. Understood. Now, going back to what you said, preparing worksheets for clients, what sort of opportunity do you see there for automation taking over to be able to go and source all the information you need, compile it, and present it to a client all autonomously?
I think that we're going to see AI jump into the business. At present, AI is not allowed to quote interest rates.
Hmm.
That may change in 2 to 3 years. But what's going to happen is more of the automation part of it. Um, I think you'll still have mortgage people pretty involved in the process. It's not that AI couldn't do what we do.
Yeah.
I don't think it's quite there yet. And I think there's just still a lot of people that just the comfort level's not quite there yet. I think it's going
Yeah.
to take a few years. But for us, and things that I'll be looking into is I see three levels of AI. One is most people use AI on the question answer level. Then you've got AI that's on the project level. I want it to go do something for me. And
Mhm.
then ultimately, I mean, I would love to have AI come in and read my emails, respond to the ones that I think it can respond to,
Mhm.
prioritize the ones that I want it to respond to personally,
Yeah.
send any contracts over to my processor. And then I'd like my processor's AI to open the contract, read the contract, find out who the attorney is, place the title order, just standard operational stuff. I think it
Right.
will streamline the process. Um, it's already pretty quick, the process is. Um, the one thing that could also come in to speed it up a little bit wouldn't be from us, but it would be automated AI underwriting, where an
Mhm.
AI agent actually makes an underwriting decision. I don't know of any lenders that are using that at this point,
Yeah.
but it is something that I think that a lot of lenders are looking at and kind of testing on the side right now.
Yeah. Interesting.
Yeah.
Now, what would the AI or the language model rather be responsible for in that underwriting? What decisions would it actually have to make in that process?
Well, there's a system now called Fannie Mae or Freddie Mac automated underwriting, and it is a super sophisticated computer program that already does
Mhm.
approve loans. And I don't know if people know this, but a person does not approve your loan. It's a computer. So it's been
Okay.
a computer for the last 15 or 20 years.
Mhm.
What an underwriter does is the computer looks at your score, it looks at your assets, it looks at your income, it calculates your debt ratios, it looks at your reserves, does all those mathematical calculations and fits you into a program. So that system approves you. The underwriter's job is to look at what the computer said and go, okay, it says that you're self-employed and that you make 80,000 a year. Okay, I need to see your tax returns and analyze your tax returns to see if you actually make 80,000 a year. It
Mhm.
says you've been on the job, so I've got to verify your job link. So the underwriter verifies all the data points that the computer used to issue or provide that approval.
Right.
So it is already a very sophisticated system. Now, what will probably happen down the road is AI will get more involved. AI can, I think, with today's technology, pretty easily scan the asset statements and make decisions and decide what's needed based on your assets. I don't know that it's at the point where it can do all the income stuff yet,
Mhm.
but I think that's where it's going to go. And you'll have on the underwriting side, you'll have computer assisted. So I think it's what a lot of people say is, are people going to get replaced by AI? I think there's a twofold answer to that, but I think more it's going to be underwriters using AI to become more efficient as
Right.
an underwriter. And it's what I want my processor to do. Look, you can train somebody for minimum wage to copy an attorney's name and place in a title order. It's not complicated.
Mhm.
Those types of things can be relegated to
Mhm.
AI and let the processor do the more complex types of things.
Right.
So I think that's where it's going to probably go for the next few years.
Yeah. Yeah, as is everywhere, right? Is AI going to replace us? No, AI is going to assist us in our day to day and help us do things faster.
Yeah, I
Mhm.
100% agree with that.
Yeah.
It's already starting to happen a little bit in the mortgage world. I certainly use an AI assistant on my website to answer questions, just to make it a little bit more user friendly for customers. Instead of having to type things in, they can just talk back and forth with my AI.
Yeah.
So I think it's going to, from that standpoint, again, I'm all about education, and I just want, clients to have that information whenever they want it 24/7.
Yeah, absolutely. Where do you want to be 6 to 12 months from now? What's the direction of your company?
I think for me, just to continue doing the same thing, just continue providing the customer service, the education, improve ways. I'm looking at a couple of different, things that I can do that will help even more explain things to customers. There are a lot of documents. It's one of the funny things. When I started in the industry, there were 14 pages of disclosures. And I think the last set we sent out was about 87 pages of disclosures.
Oh, wow.
Yeah, it's a lot. Equal Credit Opportunity Act, FACT Act, Patriot Act, right to receive appraisal, right to receive counseling. There's all kinds of different things that people have to sign. So, one of the new forms that is called a loan estimate. And that is the document that tells you all the numbers that are involved with the transaction. So I think what we're going to continue to focus on is finding better ways that make it easier for a client to understand, because that form in and of itself is just not the easiest to understand. So we've kind of created some ways to make it a little bit easier. So from my standpoint, what I want to do is just kind of keep doing the same thing, continue growing my business through referrals, just taking care of my client base. And that also entails helping past customers. It's not a part of the mortgage job, but some people call me after 3 or 4 years and say, "Hey, I'm thinking about doing this. What do you
Hmm.
think about that?" And
Yeah.
so I can't give licensed advice, but I can certainly say, here's some considerations. I know at one point, a lot of our clients for several years had rates that were 3 or 4%, even in the twos. And they were coming to me and say, "Hey, you know what? I'm going to start putting $1,000 a month towards my mortgage."
Hmm.
And we would say, "Well, let's think about that." So your mortgage is at set 3%. What kind of return on investment could you get for your money if you put it somewhere else? And they start thinking, well, I could get a CD and get 4%, or maybe I just put in the S&P, I could get maybe 6 or 7%. So I'm saying, well, would you rather get 3% on your money? Would you rather get 6 or 7% on your money? Now, I can't offer you financial advice. Talk to your financial advisor to get advice on what to buy, but they can give you guidance on that. But the kind of difference, that's called arbitrage. It's just, borrowing money at one rate and investing at a higher rate. That's what banks and insurance companies do. And so I advise my clients to do something very similar to that.
Hmm.
One of the really interesting things that happens, and again, this is just, again, food for thought for people, is I can't tell you how many people will call me after 10 years. "Randy, you're going to be so proud of me. I've been making all my mortgage payments on time. Every month I've been sticking $500 extra into my mortgage, and I've got that thing paid down from 500,000. I'm down to 250,000. And I said, "Man, that's great. Well, why are you calling me today?" "Well, my kids are a little older now. We need to finish the basement. I got to put a bedroom down there, and they want to put some things out in the yard. So I'm going to need about, 60, 70, $80,000 to finish everything."
Hmm.
So think about this. And I do this conversation up front with people now. I don't wait. If you're going to pay early into your mortgage, think about this. If you ever need that money again, let's say you've been putting 500 a month, 6,000 a year, 10 years, you got 60,000 extra. Okay. If you've been putting that money in the market, you'd have $100,000 today. So now two different people, one guy paid his mortgage down, one guy invested in the market. The guy that paid his mortgage down needs the $80,000. This is the irony of the whole thing. He's going to call me and pay me and the underwriter and the credit company and the state of Georgia and the closing attorney to get his money, that it's his money that he
Hmm.
put there. He's going to pay us to get his money out of his house.
Right.
But it gets worse, because now I'm going to give him his money, but I'm going to charge him 6.25% to 6.5%, whatever the rate is for him, to use his money.
Hmm.
The other guy, he's got $100,000. He pushes a button. He doesn't even call me. He's got $80,000 in his checking account the next day. He strokes a check for the work. He didn't pay any interest on that money, and he's got $40,000 left over.
Right.
So it's really, I'm talking myself out of business and refinances, but
Yeah.
long term financially, that saves people so much money.
Yeah.
If you can make 2 or 3 really smart financial decisions and save 10,000 here, 20,000 here, 20,000 here, over a period of time, you're going to have so much more money, as I tell people, when you retire. And that's what I want to get you to, is that place where you go, you know what? We made some good moves. We get to retire in a more comfortable place. That is my goal. It's to help you get a house, but I want to help you retire in a better place. That's my ultimate goal.
And you've been hitting the whole entire call here. You're yeah, yes, you say that you're losing business and refinances, but what you've been talking about this whole entire time and why your business has been successful is because you're investing in relationships. If you invest in relationships, then what you're ultimately doing is you're investing in your business.
100%.
Yeah.
I look at, from a business standpoint, I learned this a long time ago. I just look at the lifetime value of a customer. And most people, when I got into this business, they're very transactional. They would make as much as they possibly could on every single transaction, not thinking about you may get this one, but you missed the four behind it.
Mhm.
That's where the money is the four behind the first one.
Right. Right. Um, all right. Well, what's the biggest bottleneck in your business right now?
Biggest bottleneck? You know, I don't think we really have a big bottleneck right now.
Mhm.
2020 and 21, because the volume it's just exploded. Underwriting times right now are about 48 hours, and that's pretty typical for the industry. When we got into 2021, heck, underwriting times were maybe 14 days. And, it's just that was a bottleneck, is just getting all that volume through underwriting.
Yeah.
I don't think we really have one right now. Inventory levels, I can only speak to the like Georgia inventory levels. I'm not familiar with, specific markets, but in Georgia, the inventory levels are pretty good. They're not super low, they're not super high, they're kind of in a decent place. So there's not a ton of inventory on the market. And some of those numbers, again, I'm always a numbers guy, are a little misleading when they tell you about inventory days on market. If you had 60 houses and you sold one house, you say, okay, I got 60 days of supply. Well, if you
Mhm.
sold two houses, all of a sudden you got 30-day supply. You still have 60 houses. So the inventory level didn't change, the rate of supply changed. So you really have to look at the whole picture
Yeah.
to see how that's working. But I think overall, inventory levels are pretty good. There are still a lot of people shopping around. People are being very, very particular about
Mhm.
homes right now. I think nationally they're saying that the rate of loans that don't close is somewhere around 15 to 17%,
Mhm.
which is really high.
Yeah.
And it's high because people are going in saying, well, I want this, and this after they do their inspections, and the sellers are saying, well, we're not going to do that. And so they're just backing out of the contract. We're seeing probably more of that than we've seen in the past.
Interesting. Why do you think that buyers are backing out because the sellers aren't meeting their listed demands?
Well, it's the first part is because how they approached the market in the first place. They were a little hesitant in the first place. They decided we're going to pull the trigger, but by golly, when we pull the trigger, we're going to get the exact right house that we want. We're not going to settle, you know. And so when you go something, it's like, well, there's this whatever it is. The roof is 20 years old. We want a new roof. Well,
Mhm.
no, the roof works fine. Well, we want a new one. Well, it's then you get into the battle
Mhm.
of, well, if you're not going to give us a roof, then we're just going to back out.
Yeah. Okay.
Or it could be, the HVAC system is 15, 18 years old, needs to be, and it may need to be replaced. And you used to get away with those things. But now, because you know what, I'm really stretching myself. And here's the thing. I can afford the payment, but I don't want to get into the house and have a 10 or 15 or $20,000 repair a year or two after I make this big purchase.
Right.
And so I think that people are just being a little more particular about what they buy now
Yeah. Understood.
and the condition.
Yeah. Well, closing out here, what is some advice that you would give to someone who was getting into real estate financing?
Okay. I would tell you just very candidly, find a mentor. Most important thing you can do. I don't know if the pay is going to be the greatest, and I don't care if it's the greatest. Find somebody that you can learn the business from. This business takes, you're not going to learn it. I mean, everybody has to pass a test. But I know when they first started getting mortgage brokers this test that you had to pass to get in, I knew mortgage brokers who'd been in the business for 20 years who could not pass that test because the test really didn't have anything to do with being a mortgage broker and what we do on a daily basis. It was what regulation was created in 1954 to, we don't quote that every day.
Yeah.
So you need to, I would say the first thing is find somebody that you can mentor with who's willing to take that time. There's different categories. There's like you can go to work for a bank, you can go to work for a mortgage broker. I'm a broker, I'm an independent. I represent 30 different banks all over the country.
Mhm.
It's more complicated because I have so many more guidelines, so many more things I have to know, so many more different websites I have to be able to navigate, and little niches with each potential lender. But if you can get with somebody that can teach you the basics, and by the way, I started off with a bank. I worked with the bank for a couple of years, learned my way, and then I worked for a broker, and then I became and opened up my own shop ultimately. So I would say find somebody that you can learn from. A mentor is probably the single most important thing you can find getting into this industry. It's more important than I would say if you find the right person and it pays 10,000 less, it's worth 10 times more than that, 100 times more than that. if you can find the right person to work for.
Yeah. Find a mentor. Where can people
Yep.
find you at, Randy?
The easiest way to you can either Google my name, Randy McMullin. I'm easy to find on the internet. My website is amstarloans.com. And I've got, like I said, my AI is there. All my contact information is there. You can email me. My email is there. You can call me on my cell. I am literally available to my client base 7 days a week. If my client call me on Sunday afternoon, say, hey, we want to make an offer on a house. We need a pre-approval letter. Then you're going to get one Sunday afternoon. So just my website, probably the best way to start out contacting me, getting some information, talking to my AI if you have questions. And of course, I always suggest you call me after you talk to my AI just to make sure that you understood everything correctly. And but it's so far it's been really reliable.
Awesome. Well, if you want to talk to an AI version of Randy, go to his site. You can do it there. Thanks for coming on today and giving us some insight into mortgage brokering. Thanks,
I
man.
appreciate it. I appreciate your time, Trent. Thank you very
Yeah.
much.